Everything in this video is not intended as financial investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. We had a CPI print today that came in slightly hotter than expected, warmer than expected, still down considerably from where we were at the peak, still not down far enough to the Fed's 2% target. And we still have a long ways to go. Market, though, S&P, Bitcoin, crypto generally, sort of just shrugged it off, which is kind of surprising. Because if we look at Fed funds rate, we're not quite to 5 yet, which is the ceiling, potentially. And probabilities are now starting to price in a ceiling of around 5.5. And as we get these prints over X number of months, we may start to creep up into that 6 region. We'll see, but there's this yin and yang between how much can we go? Does it even matter that what's another 1.25, right? That's what the market's kind of saying here. We've already raised 5%. What's another 1.25? Interesting comment today from one of the Fed presidents regarding a 3% target on inflation instead of a 2% target. And if we look at the breakdown here of core CPI, it really wasn't the goods that are keeping us elevated. It's the services which continue to rise higher and have not shown any sign of slowing really thus far. And, maybe core really isn't what we need to be paying attention to. It's super core. So we keep changing, what are we measuring here? Are we measuring year over the past 2 years? And when you change multiple things, you're going to get a different outcome, a different outlook, because when we look at certain estimates like Truflation, they are showing different numbers, right? Truflation is just an estimate, a real-time estimate of where inflation could be when the CPI print comes, and this has continued to decline over the past 6 months. That decline has slowed slightly. So, I thought the next couple months CPI prints would be flat or slightly higher. So it is problematic that we're already hitting that wall. But we'll see, because Truflation has us at 5.3, which is definitely lower than 6.4, So maybe the next print will be more optimistic. But again, it's hard to know because methodologies are changing. It's like swapping out the engine while we're still moving the car here. It's hard to say. So we've got estimates, we've got real-time estimates, but at the end of the day, the market's still ruled by the BLS government number that's released once a month. I should also mention there is no meeting in April for FOMC, and these probabilities could adjust significantly depending on what economic data we get, in the month of April relative to those FOMC meetings. So something to keep in mind there. And now we move on to the interesting week that has been so far. The SEC, likely following events of 2022, is really hammering down on U.S. companies as far as making sure what happened in 2022 can't go happen moving forward. Unfortunately, that means we are penalizing, in a way, the good actors, the actors that have been here since 2013, made it through multiple cycles. It's important to keep them honest, obviously. It's important to keep them on the up and up and compliant. But if you would have told me the SEC is going after Kraken staking and Paxos, those would definitely not be on the top of my list of things to look at. But in any case, they went after Kraken's staking component, and really any staking as a service component. Their argument is, well, there weren't proper disclosures, there weren't proper risks here, and instead of what looks like a path towards compliance, they just decided to close the program entirely, which is probably the worst case scenario for Kraken and retail customers, because that pushes legitimate volume and U.S. capital offshore eventually, because we're going to start to see issues potentially with Coinbase now, potentially with other staking services, and there are many in the United States, which may just move offshore, right? If there's this voice exit loyalty paradigm, right, where if you can't feel like you get a seat at the table, a fair shake, a way towards compliance, you will exit completely and you will seek out alternative regulatory regimes. That's just the way it is. So it's really sad to see this come to that. I really hope that Kraken can figure something out going forward for U.S. retail. I've used Kraken for years. They're definitely one of the good guys. And as I said, they've been around, founded in 2011, launched in 2013, coming out of Mt. Gox, which was a disaster in 2013, 2014, and Kraken has been around just as long, if not longer, than Coinbase. So in the United States, we really don't have many options. Realistically, it's Kraken, Coinbase, Binance US, and the first two are my preference, certainly. So I really want to see them stick around for the long haul here. And Kraken acquired this staking service called Staked in December 2021. And like I said, there are many staking service providers in the United States globally that may see, additional regulatory walls get put up. It's always interesting. You go to certain websites, it says you can't access this if you're from North Korea, Iran, or the United States. And that kind of sends a message, really interesting one, when from a regulatory perspective, we're sort of lumped in with North Korea and Iran. But so far, Staked, the company, the website, still appears to be completely operational and no problems there. Secondly, this week, the SEC has gone after Paxos, which is interesting because Paxos, again, to me, one of the more legitimate stablecoin operators, but when you dig into it a little bit, kind of makes sense of what they're getting at here. But in 2021, even prior, there are certainly regulators that have said stablecoins might be securities before July 2021. But if we look at what Gensler said at that time, he said, look, even if it's a stable value backed token, which you'd think sort of outside the Howey test, right, where there is not an expectation of profit, those two may be securities depending on how they operate. And if we look at Paxos, if we look at Binance USD specifically, which is where the issue likely has occurred here. Now, the SEC hasn't brought forth charges yet, but they likely will based on the Wells notice that they received. Now, like I said, they release monthly reports here. We can look at these, and they release attestations from an accounting firm, not an audit, but an attestation, right? And they can say, look, these are the reserves, and people can match those reserves to the tokens that are circulating and sort of decide for themselves, are there a fractional reserve operation going on here? Are these under collateralized? Are they over collateralized? Typically, there's a buffer there so that these coins don't move into the under collateralization status. And if we look at what happened in reality, what I'm going to consider sort of a derivative of Binance USD's stablecoin, which was on the Binance chain, that did in fact have an under collateralization component from time to time. And based on this analysis by Data Innovation in January, we can see that there was actually quite a large, once I find it here, quite a large disparity between the supply and the actual balance. And, the negatives here represent under collateralization. So this wasn't just, a few thousand or even a few 100,000 at certain points in time. It was exceeding past, in the billions, not billion, but 1.2 billion-ish. And that certainly has raised eyebrows, right? And really for the past maybe 2 years, regulators have kind of said, look, we have ideas here. We can say we need reserves to be this. We need reserves to be held at certain places. We need likely, under collateralization components, X, Y, Z. None of those laws have been passed yet. Hopefully they will. And I do think that Binance in this case was in the wrong. So enforcement actions are certainly justified to some degree, depending on, what does Paxos, what does Binance, what do they agree on as far as under collateralization in a tokenized environment. It gets interesting how this is going to play out for sure. It's not black and white as far as stablecoins are securities. Maybe derivatives of stablecoins are securities, but we'll see. And what makes this book even more interesting is in September, they being Binance, said we're going to auto convert all these competitor stablecoins to BUSD. It's going to clean up the order books, which makes sense. It's going to allow basically our stablecoin to thrive and competitors' stablecoins to diminish, which from a business perspective makes sense. But maybe they were trying to have their cake and eat it too here. And even the New York DFS is after Paxos now for saying they didn't issue BUSD in a safe and sound manner where they were fully backed one-to-one, which, arguably, where's the blame here? Is it Paxos? Is it Binance? Is it a mixture of the two? What level of under collateralization is acceptable, if ever? These are the questions that we need answered, hopefully, with laws on the books at the federal level that says, look, banks can hold this. This is what stablecoins can hold, and that's that, right? Because instead we're kind of playing whack-a-mole, picking favorites and or just pushing capital out of the United States entirely, because it definitely helps to have clarity, not only from a customer perspective, but from a business perspective, obviously. And of course, when you have a regulatory action against a specific coin, it's probably going to see some detrimental effects on price, and BUSD did drop on the market rate below $1, whereas Tether, which is kind of universally hated by those not in the crypto industry, went above $1 because there's a demand for Tether all of a sudden if Binance USD potentially has issues with under collateralization or regularization. So that makes sense that you'd see this market reaction, and it's still disconnected from $1 on both sides of the spectrum here. And even on DeFi, if we look on Curve, which is the place we can swap stablecoins for other stablecoins, that's one mechanism you can do on Curve here. And most of the time, these pools, when operating completely all things equal, are percentage-wise equal weighted. And you can see here there's a demand for Tether because there's less Tether in this particular pool, more DAI, more USDC. And when we look at pools containing BUSD, there is a severe imbalance here because people are exchanging BUSD for Tether, And again, Tether has done some interesting things in the past, have cleaned up their act. They have a lot of baggage on what they've done. In 2018, sort of served their time, as it were, and paid their fines. But maybe inadvertently, the SEC is strengthening Tether because it is perceived largely as an offshore entity, which it operates offshore. It contains in its reserves U.S. treasuries to a great degree. And ultimately, the measuring stick's going to be circulating supply because BUSD can no longer be issued, so that'll eventually go to zero over time. USDC taking a bit of a hit here as well. There's some potential for regulatory action towards any stablecoin at this point in the United States, right? And Tether, again, just growing here kind of as if nothing's happened because people are exiting other stables for Tether, which is the perceived flight to safety there. And really the coup de grace of the week is this potential announcement on Wednesday regarding custodians and what a quote-unquote qualified custodian means for crypto. So there's more to come on the SEC side of things. And in the near term, certainly isn't great for any of the players who are still here, who are operating legally, arguably. It definitely puts a dampen on inflows into crypto if stablecoins are under fire, if crypto exchange banking gets disconnected, right? Over the long term, the hope is that we get the regulation right. We don't add on these overburdensome rules that just pushes everything offshore, and we get it figured out to prevent whatever happened in 2022. Fundamentally, though, none of this stuff affects underlying activity of any blockchain at the end of the day, really. It's truly decentralized. Bitcoin specifically, continuing to see rises in on-chain activity. That's the 90-day average. If we go on the monthly average, big spike in transactions here on-chain. Active addresses also a miniature spike, let's say. But anytime there's a spike in activity, I always like to see what's going on. We are seeing a rise in demand for transactions on Lightning Network, which is a layer 2, much like a debit system. You can't really measure transactions directly because Bitcoin in the Lightning Network is bidirectional and can happen any place at any time. And it's kind of omnipresent. That's why capacity is really the best metric. Transactions are free-ish, nearly instant, and definitely an ideal way to transact small amounts of Bitcoin. So continuing to see demand there. And really, we're also seeing a rise in non-zero addresses, which is a part of this as well, partly price related, but also because of this new use case called Ordinals, NFTs, which I talked a little bit about last week, continuing to see mints of Ordinals, which are just kind of creations of Ordinals. It is a new use case that provides a new fee revenue for the chain. Some people think it's silly, it's dumb, it's burdensome, right? That's one view. Another view is there's a previously untapped use case here that may lead to interesting things down the road. It's currently in the early experimentation phase, definitely. It is very hobbyist, very hard to do, very hard to actually access this stuff. Now there are companies going to be unlocking sort of the potential here down the road, so we'll see what happens. It's definitely early. But so far this has been a little bit more than a fad, at least in the near term, and the trend looks promising. And that's definitely showing up in the on-chain metrics. And we will look at pending transactions. It's called the mempool. We can look at the sort of the differentials between these one and done panic events where you hear an event with a custodian and you want to send a transaction quickly versus these Ordinals transactions, which have low transaction fees, but continue to sort of persist until the pending transactions are cleared. There's no rush per se here. And if we look at the blockchain size, again, this isn't a one and done event as far as the pending blocks are concerned. You're continuing to see growth in demand for block space, which fundamentally is a great thing for Bitcoin. Eventually we may start to mint Ordinals on Lightning, which is a crazy idea, but we can't always push everything to the layer 2. There needs to be a robust fee market on the layer 1 chain for the security budget eventually down the road in like 2160 when there's no more block reward. So this is really, I think, on balance, a great thing for Bitcoin to see this going on, especially in a bear market. Moving on to ETH. Now, ETH has kind of the opposite problem where the layer 2s allow people to kind of do everything they need to do without really interacting with ETH. This is Optimism, Arbitrum, Polygon. So ETH's transaction counts kind of flat or down here. So there's definitely a yin and yang between where does the value accrue? Does it accrue on the layer 2? Does it accrue on the layer 1? If it's connected to the layer 2, is the layer 2 a parasite on the layer 1, right? From a consumer perspective, it's great to see a place for fast, low fee transactions. But if you're a long-term holder in something like ETH, that may start to become problematic if a majority of DeFi, for example, goes on to layer 2, and you don't see that directly on the Ethereum chain. Now we are seeing continued burning of ETH. We're seeing continued ETH being locked up in the staking contract. Just today we had an NFT token mint for Blur, some NFT exchange, and we saw a sudden spike in fees, and that definitely helps the burning mechanism here. So ETH is continuing its deflationary journey so far, and there really has not been a price impact yet. But the idea here certainly is that eventually, as the supply has a ceiling and sort of stagnates, and you continue to see burning of the supply, that does have an effect on price. Moving on to technicals real quick. Like I said, the S&P just kind of seemed not unexcited, nonplussed, unaffected kind of really by the CPI data. We have more economic data, between now and the FOMC, so I'm sure we'll be talking about everything from consumer spending to PPI and all this other stuff. But so far, so good from a technical perspective. Definitely maintaining a golden cross here on 5200 MAs above the inverted head and shoulders neckline from a chart pattern perspective. And the long-term target's definitely somewhere between 4,500 and 4,700. So this looks good. In order for this thing to really get concerning, I would get concerned on the S&P below 4050 and ultimately really below the 200-day moving average. But as it sits now, looks perfectly fine for bullish continuation. And really, as does Bitcoin, as does Ethereum, as it's on the right side of this confluence of previously resistance, hopefully here turn support. We haven't had a proper support test yet. We're getting close to that 20K level, but most of the MAs that are relevant sit at the 20K level, with resistance and the 200-week moving average, which is what this is here, at around 25K. So the long-term target for Bitcoin, 3 to 6 month target, somewhere between 30 and 35K, certainly reasonable based on a range breakout here. And for ETH, arguably even more bullish looking than Bitcoin, still very much range bound, but above those key moving averages, above the cloud. And I like a long-term target of 3K and a near-term target of around 2,000, as long as this, 14, 15 level can hold, and ultimately this diagonal support currently somewhere around 1250, let's say. So that's where ETH starts to get in trouble, where we get more into this, turtle soup, random walk, range bound stuff below 1200, and things become less bullish down there. That's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.